While the news has been very focused on Trump and Elon, I think many have missed the biggest story in the market. We're going to talk about it today on the Weekly Update. Okay, friends, let's talk about the earnings season roundup. Here's what you need to know. First up, despite the news cycle at a fever pitch, stocks are still valued off of earnings. And I am very thankful that other than the intro and this statement I'm about to say, we're not going to talk about Donald Trump or Elon Musk or anything in the news today, because I think that stuff gets focused on plenty of other places. We're going to focus on the important stuff, right? Earnings. And why earnings matters, because stocks are valued off of earnings, and we're about 80% of the way done with earnings season as of right now. The first quarter always stretches long. It's going to go into March before it's all done. But we've got a good enough flavor now. Let's see what's going on. So here we go. Here's earnings. 77% of companies have reported their results. 76% have reported a positive earnings surprise. 62% of companies have reported a positive revenue surprise. So if you remember, I talk about earnings. Earnings are good. 76% beat. That's pretty much what you'll always get. What I like to look at, what's more important to me, are revenue surprises, because you can't control your top line. The top line gives us a really good read on what the economy is doing. Your earnings beat, it's really a function of how good your accounting is. Earnings growth, though, so earnings growth is real. For Q2 2024, the year-over-year earnings growth rate is 16.9%. So if you're growing your profitability 17% a year, you're doing pretty well. And so one of the things that I think, why the stock market has been so strong for the last 2 years and so strong into the start of this year is because of the earnings picture. Earnings have been growing. Corporate America has been doing fantastic, and we clearly have the data here now. If we look at earnings guidance, so this is CEOs telling us what they see in the future. 42 S&P 500 companies have issued negative guidance. 33 have issued positive guidance. And so what this tells us some things about what's happening in the environment going forward. And what we know is, based upon 42 negative, 32 positive, that tells us that Q1 2025 is going to be tough. This is that economic storm that kind of shows up here and there, but has basically been going on for a couple months now. We can start to see it show up in the numbers. Finally, valuation. If there is one knock on this market, all of this stuff is great. This is all positive, and this is all what you would see from a very strongly performing market. The only knock that you can give the market right now is valuation. The forward 12-month PE ratio, so what we're paying for earnings, is 22.2, and this is above the 5-year average of 19.8 and the 10-year average of 18.3. So we've got a great scenario, right? There is a good setup here, but we're certainly paying for it. The market is, fairly expensive right now, given how good the environment is. And so we want to be careful. Yes, the environment is good, but we also want to be careful that the market doesn't get ahead of itself too much and thinking that the environment is better than what's actually going on. Let's take a look at some charts here. This is S&P 500 earnings above, in line, or below estimates for the fourth quarter. Here's the S&P 500, 76% beat. And here's the thing I want to focus on. So let's look at where there's strength and where there's weakness. If we look over here on the strength side, healthcare, information technology, communication services, and financials, great. These four are doing better than average, and those four are the largest segments of the economy. So that's pretty good, or largest segments of the market, at least. If you look here at industrials actually matter a whole bunch to the economy. This is people actually having to do something other than, maybe just, social media networks. So all of this looks good, strong, positive from what I can see. If you look at the areas where there's some weakness, utilities, real estate, materials, consumer staples, this is sort of that inflation trend and the interest rate trend. It's okay if these guys are weaker because they are much lower segments of the S&P 500. So if there's weakness there, that really doesn't impact the market at all. If we look at revenues here, above, in line, or below estimates. So here's a good one. The S&P 500 revenues above 62%, only 38% below. And if we look at the areas that are missing on revenue, materials, utilities, industrials, real estate, again, so I'm not too worried about them. Yes, their top line is challenged, but they're small segments of the market. Healthcare, information technology, consumer discretionary, 76% above. That's people having extra money to buy stuff. That's pretty good. There's a lot of really good stuff here when we look at the revenues. As we look forward to next year, though, what are the earnings expected for next year? We're expecting an earnings growth of 13%. Now that's pretty good, right? We're in the middle of an economic storm. Earnings growth last year was 17%. If things get bad, but we walk away with 13% earnings growth, that's pretty strong for next year. And the following year, analysts are projecting 14% earnings growth. Now, these are analyst projections, so we don't want to run away with them, but this would be very positive indeed. And finally, last thing, if we look here on positive and negative guidance, the S&P 500 basically, now we've tipped over. More companies are issuing negative guidance than positive guidance. And what I'm taking from this sounds bad at first if I tell you, hey, companies say the future is going to be worse than the past, right? That doesn't sound good. But what this is a good check for us for CEOs getting too complacent. Right? If they think, hey, everything's great, then if everything doesn't turn out great, we might be in trouble here. The market already knows all this information and stocks are where they are. So I actually look at this as good conservative guidance. If there's a low bar, it's much easier to step over it. So what I like is corporate America and CEOs are giving themselves, they're sort of foaming the runway a little bit here. So what does it all mean? Earnings season roundup? Well, Q4 earnings have come in very strong. Corporate America is doing really well. Expectations for 2025 are similarly strong and should bode well for the market. CEOs are being rational with their forward guidance. No euphoria here. All of this is great. The only thing I'll say, the only fly in the ointment of this party is the economic soft patch seems to be growing. And we're going to need to fix that at some point in 2025. So there you go. That's our earnings season roundup. We talked for 5 minutes about something going on in the world, and we didn't have to mention Donald Trump or Elon Musk even once. There you go. I'll see you for the weekend review. Take care. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe, you'll be the first to know as soon as we upload anything. Appreciate it. See you soon.